The past few days have been some of the most intense for the world of blockchain and crypto. The market is going through one of the biggest drops of the year, regulators are preparing new laws, and traditional banks are openly integrating digital assets into their systems. All of this marks a new phase in the evolution of blockchain technology, and now is the perfect moment to understand what's happening and where things are heading. Let's start with the big one. Bitcoin has plunged over the past 6 weeks, losing more than $30,000, one of the sharpest declines since late 2022. Experts attribute this to massive liquidations of leveraged positions and the growing concentration of Bitcoin among large holders, the so-called whales. When the market overheats, a single sharp move downward is enough to trigger a chain reaction of forced liquidations. But this isn't a sign of blockchain's weakness. It's a reminder that market psychology still dominates the crypto industry. Another major story of the week is the growing connection between crypto and traditional finance. Fresh reports show that U.S. banks are now officially allowed to use cryptocurrencies and blockchain platforms in their operations. This shift became possible after new guidance from the Office of the Comptroller of the Currency. For years, banks kept their distance from digital assets. Now, they see blockchain as a tool to speed up transactions, increase efficiency, and reduce costs. In other words, financial giants are beginning to recognize that blockchain isn't just about crypto, it's the infrastructure of the future. And the regulatory landscape is evolving rapidly. The U.S. is close to passing a new framework for the crypto market, one that establishes clear rules for exchanges, custodial services, tokenization companies, and digital asset platforms. If adopted, this would be the first time the crypto industry operates within such transparent and predictable boundaries. This could open the door for institutional investors, hedge funds, banks, and insurance firms who've been waiting for regulatory clarity before entering the market. At the same time, blockchain as a technology is more in demand than ever. Companies are adopting blockchain to improve supply chains, enhance data transparency, and automate operations through smart contracts. Finance is seeing a surge of interest in asset tokenization, real estate, bonds, stocks, allowing faster settlements, lower fees, and higher transparency. What once seemed experimental is now becoming a fundamental part of the global financial system. But with growth come new challenges. Scalability remains one of the key issues. Most blockchain networks simply can't handle the volume of transactions required by the global economy. Another challenge is the lack of unified standards. Different blockchains operate separately, limiting interoperability. Cross-chain solutions are beginning to address this, but there's still a long way to go. And of course, security risks rise as adoption expands, from cyber attacks to looming threats tied to quantum computing. Still, the overall direction is clear. Blockchain is entering a phase of maturity. Financial institutions are integrating it, regulators are setting the rules, and the market is learning to survive extreme volatility. We're standing at the threshold of the biggest changes in digital economics in a decade, and blockchain is at the center of it all. In the coming months, we'll see which way the momentum shifts. Will blockchain become the backbone of global financial infrastructure? Or will the technology hit another temporary slowdown? One thing is undeniable. Ignoring what's happening is no longer an option. Blockchain is no longer an experiment. It's the foundation on which the new digital economy is being built.